Welcome to this session of Physical Academic Tutorial on IFRS 18, Presentation and Disclosure in Financial Statements. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, thank you for being part of this channel. IFRS 18, Presentation and Disclosure in Financial Statements, states that a complete set of financial statements comprises, number one, we have statement of financial position, statement of financial position. Number two, we have either a statement of profit or loss and other comprehensive income. Either of these two. Either a statement of profit or loss and other comprehensive income. Or a statement of profit or loss plus a separate statement showing comprehensive income. A separate statement showing a comprehensive income. Three, a statement of changes in equity. A statement of changes in equity. A statement of changes in equity. Number four, we have a statement of cash flows. A statement of cash flows. Number five, accounting policies and explanatory notes. Accounting policies and explanatory notes. These are the complete set of financial statements in accordance with IFRS 18. The purpose of financial statements is to provide the users about an entity's assets, liabilities, equity, income, and expenses. These are the 5 elements of financial statements. Financial statements. Of these 5 elements, the first 3 are usually reported in the statement of financial position. That is, assets, liabilities, and equity will be recognized in the statement of financial position, while the last 2, income and expenses, will be reported in the statement of financial performance. I have told you that of these 5 elements, the first 3 will be recognized in the statement of financial position. What is a statement of financial position? A statement of financial position is a statement that reports assets, liabilities, and equity of an entity as at a particular date. A statement that reports the assets, liabilities, and equity of an entity as at a particular date. Therefore, what are assets? Assets are the present economic resources controlled by an entity as a result of past events. The present economic resources controlled by an entity as a result of past events. In accordance with IFRS 18, assets will be categorized into two. We have the non-current assets. Number one, non-current assets. Non-current assets. Non-current assets are the assets with the following features. Assets with the following features. Number one, they are expected to be used for more than 1 year. Any asset that is expected to be used for more than 1 year are said to be the non-current assets. I've told you that the non-current assets are assets with the following features. Number one feature of the non-current assets is that they are expected to be used for more than 1 year. They are expected to be used for more than 12 months. Number two feature, they are held for use in the production. They are held for use in the production or supply of goods or services or for administrative purposes. Assets that are expected to be used in the production or supply of goods or services or for administrative purposes. Those assets are said to be the non-current assets. Examples of non-current assets include, number one, we have property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment in accordance with IAS 16. IAS 16. Property, plant, and equipment. Examples of property, plant, and equipment include the land and building, motor vehicles, furnitures and fittings, premises, plant and machineries. Those are the examples of property, plant, and equipment. Number two, we have intangible assets. Intangible assets. Intangible assets. This is covered in IAS 38. Intangible assets. So in accordance with IAS 38. Then number three, we have investment property. Investment property in accordance with IAS 40. IAS 40. That is the standard on investment property. Then we also have financial assets in accordance with IFRS 9. Financial assets. Number four, we have financial assets. Financial assets in accordance with IFRS number 9. Then we also have rights of use assets. Rights of use assets in accordance with IFRS number 16. Rights of use assets in accordance with IFRS 16. Number 6, we have the deferred tax asset. Deferred tax assets in accordance with IAS number 12. So, all these are examples of non-current assets. Then we also have the current assets. Number 2, we have current assets. Current assets. Current assets are the assets with the following features. Number one, they are held for trading purposes. Assets that are held for trading purposes are said to be current. Current assets are assets that are held for trading purposes. Number two, the entity expects to realize the assets. The entity expects to realize the asset or sell the asset or consume it in the normal operating business cycles. The entity expects to realize the assets or sell the assets or consume it in the normal operating business cycles. Number three, the entity expects to realize the assets within 12 months after the reporting period. The entity expects to realize the asset within 12 months after the reporting period. That is, the entity expects to sell the asset within 12 months after the reporting period. Number four, it is cash or cash equivalent unless the asset is restricted from being used for at least 12 months after the reporting date of the entity. I repeat, it is cash or cash equivalent unless the asset is restricted from being used for at least 12 months after the reporting date of the entity. Examples of current assets include: one, we have inventories. Two, we have trade receivables. Three, we have other receivables, such as prepaid expenses. Other receivables, such as prepaid expenses. Number four, we have cash and cash equivalent. These are some of the examples of current assets. The second element that will be recognized in the statement of financial position are liabilities. What are liabilities? Liability is the present obligation of the entity to transfer an economic resource as a result of past events. The present obligation of the entity to transfer an economic resource as a result of past events. In accordance with ISB conceptual framework, liability can be categorized into two. Number one, we have the non-current liabilities. Non-current liabilities. When we say current is usually used to refer to time. Non-current, it means when something is current, that means it is within 12 months. Therefore, non-current liabilities are those obligations due for settlement within period which is more than 12 months after the reporting year end. Obligations that are due for settlement within period which is more than 12 months. Obligations that are due for settlement within period which is more than 12 months after the reporting year end. Those obligations that cannot be settled within 12 months, we refer to them as non-current liabilities. Examples of non-current liabilities, we have loan notes or debenture or loan notes. Number two, we have the deferred tax liability. Then we also have the financial liability. Then we have lease obligation. Lease obligation that are not expected to be settled within a period of 12 months. We have them as non-current liability. We also have redeemable preference shares. Preference shares. Redeemable preference shares. These are some of the examples of non-current liability. Then we have number 2. We have current liabilities. Current liabilities. Current liabilities are liabilities due or expected to be settled within an entity normal operating cycle or within 12 months after the reporting year end. Those obligations that are due for settlement within 12 months after the reporting year end, we refer to them as current liabilities. Current liabilities are obligations that are due for settlement within 12 months after the reporting year end, after the year end of the entity. Those obligations that are due for settlement, we refer to them as current liabilities. Examples include, we have the trade payables, trade payables. Then we have other payables, such as accrued expenses. Then we also have bank overdraft. Then we also have income tax liabilities. These are some. Then we also have financial liabilities that are due for settlement within 12 months. Financial liabilities. Those ones that are due for settlement within 12 months. The current portion of it. We have financial liabilities under non-current. Those ones that will not be settled within 12 months. While those ones that will be settled within 12 months, we have them as current liabilities. Then we also have lease obligations. Those lease obligations that are not due for settlement within 12 months. We have them as non-current. While those ones that are due for settlement within 12 months, we have them as current liabilities. The third element of financial statement that will be recognized in the statement of financial position is equity. Equity are the residual interest in the net asset of an entity. The residual interest in the net asset of an entity. That is equity. We have accounting equation. Assets equals to capital, and the capital are the equity plus liabilities. So if you make your equity the subject, so you have equity equal to assets. When this one comes with it, this plus become minus liabilities. So that is why we say the residual interest in the net assets of an entity are the equity. We have two components of equity. Equity have two components. The number one component of equity is share capital. And the second component of equity are reserves. So equity have two components. Number one, we have share capital, and the second component, we have reserve. Under the share capital, we have the ordinary share capital. And then we have irredeemable preference shares. shares. So the share capital include the ordinary share capital and irredeemable preference shares. Then reserves include, under the reserves you have retained earnings. Retained earnings, we have share premium reserve, share premium. Then we equally have the revaluation reserve, revaluation reserve. These are the components of equity. Having examined those elements of financial statements that will be incorporated in the statement of financial position, we therefore want to give the format of statement of financial position in accordance with IFRS 18. Format of statement of financial position, you may have the name of the entity. Suppose it is SYZ Limited. You have statement of financial position as at note, it is as at not for the year ended. If you put for the year ended, you'll be penalized. It is written as at, you put the year end. Suppose the year end is December 31st, 20XX. So the starting point will be assets. So you have the assets. The first category of assets to start with will be the non-current assets. Non-current assets. You may have note. The first non-current asset will be property, plant, and equipment. So I want to put note 11. I want to assume that the statement of profit or loss and other comprehensive income will have been prepared, where you'll be having note 1 to 10. So the number, this may not be note 11. Suppose the last note in your statement of profit or loss is note 5. That means this will be note 6. So your property, plant, and equipment. Now, I want to have the note 11 now. Note 11, which shows the calculation of the figure of property, plant, and equipment that will appear in the statement of financial position. So you have property, plant, and equipment. So let us assume this is total. This is furnitures and fittings. This is for motor vehicles. This is plant and machinery. This is land and building. So you may start with the opening balance brought forward, which will be at the cost of each of the assets. Then you have addition. You can only have this addition if there is an acquisition of property, plant, and equipment during the year. It is the one acquired during the year you will have as an addition. Let's assume plant and machinery were acquired. So the same amount will be the total. Then disposal. Disposal here should be reported at cost. Let's assume motor vehicle were disposed during the year. The one disposed will be subtracted. Then after that disposal, let us assume you have revaluation. Revaluation surplus. Suppose land were revalued upwards. So you have it there. The same revaluation surplus will be written in the total column. And if it is revaluation deficit, you subtract. That is downward revaluation. Then reclassification. Reclassification. Suppose plant and machinery were reclassified to motor vehicle. That means you remove it from plant and machinery, it comes into the motor vehicle, so you won't have it in the total if the amounts are the same. The amount of reclassification, if they are the same, but if it is a different amount, then the net difference will be in the total. So you sum them up. So balance at year end. Let me assume this balance is A. Then after the cost, then the next section will be depreciation. The depreciation of property, plant, and equipment. So you have depreciation. In this section, you start with the opening balance. Opening balance, which is balance brought forward. This is the accumulated depreciation, the opening balance. Then the depreciation charge for the year, the one charged as an expense in the statement of profit or loss, charge for the year. So you have it here. Then after this, you may have disposal. The depreciation, accumulated depreciation of the asset disposed up to the date of disposal. You remove that. Then after this, you have the total, which is the accumulated depreciation to date. This is accumulated depreciation. Accumulated depreciation. Let's have this as B. Then you have carrying amount. Carrying amount. Carrying amount at the beginning. The carrying amount at the beginning will be cost at the beginning less depreciation at the beginning. While carrying amount at the year end. And that will be A minus B. A minus B. That will be the carrying amount at the end of the year. It is the total carrying amount at the year end that will appear in the statement of financial position in note 11. Intangible assets. This will be measured in accordance with provisions in IAS 38. Intangible assets. Then we have investment property. Investment property will be measured in accordance with the provisions in IAS 40. Investment property. Then we also have financial assets. Financial assets, you measure this in accordance with the provisions in IFRS 9. So the one that is not, the one measured at fair value through other comprehensive income. Then we also have right of use assets. Right of use assets. Then this will be measured in accordance with the provisions in IFRS 16. Then we have deferred tax assets. You measure this in accordance with the provisions in IAS 12 income tax. So when some of the non-current assets, you have this as the total. After the non-current assets, then you have current assets. Current assets. Our current assets include inventories. Inventories, you measure it in accordance with the provisions in IAS 2. Inventories. We should find that inventory should be measured at the lower of cost or net realizable value. After inventory, you have trade receivables. Trade receivables. Then after trade receivables, you may have other receivables. Then you may have cash or cash equivalent. These are some of the current assets. You sum up the current assets in order to get the total. You now add the current assets and the non-current assets to get the total assets. The total asset will be current assets plus the non-current assets. So we have total assets. After total assets, we have equity and liabilities. So we start with equity. I've told you that equity have two components. We have the share capital and we have ordinary share. After ordinary share, we have irredeemable. Irredeemable preference shares. Unless stated otherwise, all preference shares are irredeemable. Unless stated otherwise, all preference shares are irredeemable. It means if you are given preference shares in the question, if it is not cumulative, if you are not being told that it is redeemable, you know it is an irredeemable. Cumulative preference shares are not redeemable. They are redeemable ones. Cumulative preference shares are redeemable. So you have it as debt, not current liabilities. But irredeemable preference shares, they are part of equity. Then we have share premium. Share premium reserve. Share premium reserve. It is part of equity. Then after share premium, then you have other components. We have retained earnings. Retained earnings. After retained earnings, we have other components of equity. The major item you may have under these categories are revaluation reserves. So if you sum up this, other components of equity are revaluation reserves. So you get the total equity. This is the total equity. After total equity, then you consider the non-current liabilities. Non-current liabilities. As part of non-current liabilities, you may have loan notes, or debenture. Loan notes or debenture. You may have lease obligation. Lease obligation. In accordance with IFRS 16, this lease obligation will be categorized into current and the non-current liabilities. The non-current one, the one that will not be settled within 12 months, that is the one you will have under non-current liabilities. While the one that will be settled within 12 months, you have them as current liabilities. So you have financial liabilities. Those liabilities that will not be settled within 12 months, you have them here as part of our non-current liabilities, the financial liabilities. Then you have deferred tax liabilities. Deferred tax liability. Deferred tax liability, you have it here. So you sum up your non-current liabilities, you have this as the total of our non-current liabilities. After the non-current liabilities, then you have the current liabilities. Current liabilities. Our current liabilities include trade payables. We have other payables in form of accruals, other payables. We have lease obligation. I've told you the lease obligation will be categorized into current and the non-current liabilities. Financial liability. The financial liability, you know, I have financial liability under non-current. It is the current portion of it that will appear here, while the non-current portion will be categorized as non-current liabilities. So, bank overdraft is part of current liability. Bank overdraft. So, these are some of the examples. The income tax liabilities. So, you sum up your current liabilities, you have this at the total. You add the equity plus the non-current liabilities plus current liabilities, then you get the total equity and liabilities. Total equity and liabilities. Total equity and liabilities. I will stop this lecture here. My part 2, I will examine the statement of profit or loss and other comprehensive income and statement of changes in equity. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.